So welcome back to our video lecture. So on this video, we are going to focus more on the accounts receivable. So we all know that accounts receivable is one of the two trade receivables, the accounts receivable and the notes receivable. Accounts receivable is a contractual rights to receive cash from its customer. So this accounts receivable is created from the ordinary course of business. This is an open account. This is a verbal promise from customer to pay the company a certain amount on a specified date. Okay, so how do we measure this accounts receivable? We measure accounts receivable in two different ways. We measure accounts receivable on initial measurement and subsequent measurement. So we measure our accounts receivable in two different ways, the initial measurement and the subsequent measurement. Let me explain this further. Let me draw some line here. All right, we have our January 1st and our December 31st right here. So let's say, for example, on July 1st, the company sold goods to a customer. Right. On July 1st, the company sold the goods to a customer. That creates the accounts receivable. On July 1st, this is your transaction date or your sale date. So on transaction date, this is your initial measurement of your accounts receivable. Initial measurement or measurement is how much do you recognize this accounts receivable on the initial measurement or on your transaction date. So on the transaction date, this is your initial measurement of your accounts receivable. And on December 31st, where the company's accountants prepares the financial statement of the company, they will measure the accounts receivable again on the financial date, and that's what you call the subsequent measurement. All right? This is your financial date. And this is where you subsequently measure the accounts receivable. All right. All right. We measure our accounts receivable in two different ways, the initial measurement and the subsequent measurement. The initial measurement is when the transaction occurs, the transaction on the transaction date, that's your initial measurement. And when the accountant prepares for the financial statement of the company on the financial statement date, which is December 31st, that is your subsequent measurement. All right. Now, what is our initial measurement of our accounts receivable on the transaction date? Our initial measurement of our accounts receivable is the face amount. What is a face amount? Face amount is how much is the customer owes the company. That is your face amount. So when the problem says the company sold 100,000 to a customer, then 100,000 is your face amount. But when a company sold goods to a customer with a list price and offers a trade discount, our initial measurement will be original invoice amount. All right. So when the company offers the customer a list price with a trade discounts, our initial measurement then will be the original invoice price. So original invoice price is equal to the list price minus our trade discounts. So how do we do this? How do we calculate the invoiced amount? Let's say, for example, we have a list price of 100,000. To calculate for the invoiced amount, All right, first is we have our list price. Let's say, for example, we have a list price of 100,000. All right. Now, the company offers two trade discounts. Let's say, for example, the company offers 10% of first discount and 15% on the second discount. So, first discount, we less the first discount, trade discount, which is 10%. That means 100,000 times 10%. So 100,000 times 10% is 10,000. So we less 10,000 to the 100,000 to come out with 90,000. All right. Now we less second discount. So the company offers another discount, second trade discount. All right. From the second discount, we take 90,000 times the 15%, for example, the 15% of the second discount, second trade discount. So 90,000 times 15,000 is 13,500. All right. Then we less the second discount on the 90,000, we get 76,500. And this is your invoiced amount. All right, so on this problem, on these examples, we calculate the invoice amount as list price of 100,000 less the first discount of 10%. 100,000 times 10% is equal to the 10,000. And we less that, we get 90,000. And 90,000 will be the basis for the second discount. 90,000 times 15,000, 15% of the second discount, we get 13,500 as the second trade discount. So the invoice price is 76,500. Now the list price and the trade discount is not recorded on the company's accounts receivable or on the company's book. We ignore the trade discount and the list price. We only use list price and trade discounts to get our invoice amount. The invoice amount is what we record as accounts receivable on the initial transactions or transaction date. Now, for subsequent measurement, where the accountant prepares the financial statement of the company at the end of the year, the accounts receivable will be measured at a net realizable value, or what we called NRV, net realizable value. Okay, let me repeat this. Accounts receivables are contractual rights to receive cash from our customer. So we measure our accounts receivable in two different ways: the initial measurement and the subsequent measurement. The initial measurement is when we first encounter the transaction, the selling of the goods on the transaction date. That's our initial measurement. On the December 31st end of the year, where the accountant prepares the company's financial statements, we measure our accounts receivable again, and that's what we call subsequent measurement. On initial measurements, we measure our accounts receivable at face amount. What is a face amount? Whatever is the amount the customer owes the company, that is your face amount. Or your original invoice price is also your initial measurement. If the company gives list price less trade discounts to the customer, the invoice price is when you less or deduct all the trade discount offered by the company. All in all, or the net amount of that is your invoice price. Subsequent measurement is measured at net realizable value. Therefore, on the financial date or the financial statement, we measure our accounts receivable at net realizable value. All right. Now, let's talk about the net realizable value. So, when we say net, we are going to minus or deduct some items on the gross amount to get the net amount. Okay? The net amount. So, for net realizable value from the accounts receivable, so from the gross amount of the accounts receivable, we will minus or deduct some items to come up with the net realizable value. And what are these items that we have to deduct from our gross accounts receivable? And these are, so after deducting or minus all of these allowances to the accounts receivables, we get our net realizable value of our accounts receivable. All right, now let's discuss about allowance for freight. So allowance for freight, we will discuss freight or delivery expense on our inventory video lectures more in detail than here on accounts receivable. So let's pretend or let's assume the company is responsible for the delivery expense of a certain goods that was shipped by the company. So allowance for freight, our entry will be debit to freight out and credit to allowance. All right, this is the journal entry when you set up an allowance for freight. We assume that our company is responsible for the delivery expense of a goods that was shipped to the customer. So this is your journal entry. For sales discount, a company usually offer a cash discount to encourage customers to pay on time. Okay, so if we have some sales near the end of the year and we expect this customer to avail for a sale for the cash discounts, then we will have to set up this sales discount or allowance for sales discount. Okay, and our entry to set up the allowance for sales discount is debit to sales discount and credit to allowance for sales discount. Now, for allowance for sales return, we all know that in business there will always be a sales return. Some customers may not be satisfied with our product. So, in business, there will always be a return. That's just part of the business. So, to set up an allowance for sales returns, we debit sales return and we credit allowance for sales return. Now, for allowance for doubtful accounts, it's always part of the business that there will be some customers who cannot pay their accounts or their dues. So, we companies usually set up an allowance for doubtful accounts. So the entry to set up an allowance for doubtful accounts is debit to doubtful account expense and credit to allowance for doubtful accounts. All right. We will discuss more of the doubtful accounts expense in a little bit here. So on our receivables, on our net realizable value of our accounts receivable from the gross amount of the accounts receivable, we minus allowances. Allowance for freight, allowance for sales discounts, allowance for sales return, allowance for doubtful accounts. All of this minus on the gross amount, we get our net realizable value. For allowance for freight, we assume that our company is responsible for the delivery expense. For freight out, this is your expense or selling expenses. For sales discount is a contra account for sales to get the net sales. So this is a contra account of net sales. And sales return is also a contra account to your sales to get your net sales. All right. And doubtful accounts is also your expense. So we have two contra accounts, the sales discount and the sales return. The doubtful accounts is expense as well as your freight is expense. Freight out. The freight out plus your doubtful accounts, those are your expenses. Sales discount and sales return are contra accounts of your sales to get your net sales. And this is our accounts receivable.